Dell's working capital, Group 2. Question 1. Dell's sales grew from 1995 to 96. In Exhibit 5A, we find the projected balance sheet items if there were no changes in operating efficiency, which suggests that growth could be funded entirely with internal funds. Was it? More specifically, how much of the growth in assets was actually funded internally versus through external funds? Did changes in operating efficiency help or hinder the firm's ability to finance its growth internally? In order to answer this first question, we calculated the asset turnover ratio, short-term investments as a percentage of sales, and current liabilities as a percentage of sales for years 1995 and 96. After comparing the solutions of these calculations, we observed the asset turnover ratio increased from 2.18 in 1995 to 2.46 in 1996. Therefore, the efficiency of the firm also increased. Current liabilities as a percentage of sales decreased from 21.6% to 17.7%. Therefore, liabilities have also reduced. Dell funded its 52% growth in sales mainly by increasing its asset efficiency, reducing its current liabilities, and decreasing its short-term investments in comparison to the earlier year. Question 2. Assuming sales will grow 50% in 1997, is it possible to fund this growth internally, assuming no economies of scale or gains in efficiency? Here are the calculations in order to determine the 1997 forecast, which is the first part of determining whether or not there is a financing surplus or deficit. After that, this is how we calculated the total liabilities and stockholders' equity, which is needed for the second part of the surplus deficit equation. As you can see, there is a financing surplus of $98 million, and therefore Dell can fund the growth internally. Question 3 asks us if the answer to question 2 changes if Dell also plans to repurchase $500 million of common stock and pay off all of its long-term debt. As you can see from the previous question, the 1997 forecast assets do not change. But we can see $113 million of long-term debt that is paid off, as well as a $500 million buyback of common stock, which results in a $70 million negative value due to the difference between the book and the market value. In 1996, Dell has a book value of stock totaling $430 million. It is assumed that the market value of this stock is higher than the book value. If Dell purchases $500 million of its own common stock, it would have a negative book value of $70 million, since only $430 million of stock is available on the balance sheet. Stockholders' equity and liabilities are used to pay for operations. Since assets are investments used to add more value to the company, they will not be used to fund the business. The negative $70 million in stock is accounted for in the total shareholders' equity. To determine financing needs, subtract the total assets from total liabilities and stockholders' equity, and we find that there is a $516 million financing deficit. To fund the growth internally, Dell may continue the trend of increasing asset turnover rate, continue the trend of reducing liabilities, or leverage delaying paying vendors until its operations have been funded. As we saw from the previous slide, if Dell chose to buy back $500 million of stock, it could no longer fund its growth internally because its needs exceed the options it has available. Dell could seek additional financing of $516 million to maintain the level of expected growth. We found from question 3 that Dell needs to free $516 million to finance the 50% growth internally while repurchasing $500 million of common stock and paying off all of its long-term debt. Question 4 asks us to see if this can be accomplished just by increasing efficiency of the company. The cash conversion cycle is a measure of how efficient a company is in using capital to buy inventory, turn it into a product, sell it, and receive payment for that product. Cash conversion cycle can vary drastically from industry to industry. A lower cash conversion cycle within an industry indicates a more efficient company. This chart illustrates Dell's financial ratios from 1993 to 96, showing the modest improvement that they have had in reducing their cash conversion cycle. From the 1996 actuals and 1997 estimates, we see that Dell currently has a 47-day cash conversion cycle. If Dell was trying to free up financing by simply reducing inventory held, they would have to cut nearly 30 days off of their days sales of inventory, which seems rather difficult. Likewise, if Dell was trying to get this financing by decreasing the amount of time it takes to collect from accounts receivables, they would have to cut DSO by almost 24 days, also difficult. Dell would also have to delay payments to accounts payable by nearly 30 days in order to gain this financing. However, if Dell tried to gain efficiency across all aspects of the business, with 60% coming from decreased inventory, 20% from quicker collections, and 20% from delaying payments, there is a feasible way to fund this internally. The change to the cash conversion cycle is 28 days, but the bulk of that can be accomplished by changing to a build-as-ordered manufacturing process, thereby reducing inventory. If Dell could accomplish all of this while not causing large increases in delivery time, it would be a wise approach. This chart illustrates how the cash conversion cycle trend line would look through 1997 with the increased efficiency. Now, in question 5, shown here, we are asked to investigate achieving our financing goals without any increases in working capital efficiency, as we previously looked at, and only focusing on increasing our profit margin. For this question, we will first calculate the profit margin that would be required, and then follow up with a discussion on the feasibility of these operating changes. Now we will begin by calculating the required profit margin in 1997. First, starting with the assets section of the balance sheet. In this question, we are also still assuming the 50% increase from sales from 96 to the amount of $7.994 billion, as used in the other equations. Here you can see the assets section and that these figures are not changed from question 3. Looking at the liabilities and equity section, you can notice the differences from the original question, highlighted in yellow here. The first item is long-term debt, which we have reduced to 0. The second is the common stock buyback. Lastly, you can see the point of interest for this question, the retained earnings, which has been increased to $1.493 billion from $978 million, a difference of $516 million. The difference is the amount required to bring our additional funding need to 0, having total assets and total liabilities and stockholders' equity equal at $2.928 billion. Please note that these figures are rounded to the nearest million. As we know that we need to have the retained earnings equal to $1.439 billion as per the previous slide, that shows that for the 1997 income statement, we must have a final net profit of $923 million. To achieve this with our set tax rate, we must have an increase in pre-tax income of $628 million from 1996, assuming financing and other income remains constant. This shows us that the required profit margin is 11.62%. Please note that the income here was put in with financing and other income, but in reality, this would need to be accomplished through a reduction in cost of sales or other operating expenses. An 11.62% profit margin is not feasible at this time, as it is unlikely given the increase in the supply side of the equation for Dell, meaning that as our sales grow by 50%, it is unlikely that we will be able to increase profit in such a drastic manner as stipulated here, especially when considering the tax implications required. Increasing net profit by over $700 million would be extremely difficult. This shows that it is much more feasible and easier to meet our goals by adjusting the cash conversion cycle than it is to simply increase our profit margin given the estimated sales growth of 50%. Going forward with the pro forma here would be unrealistic.